Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with a new guest on the show, Lawrence Lepper, Gold Stock Fund Manager, also investment manager at Equity Management Associates LLC. Now, Lawrence, I've followed your work for quite a while, so I'm really quite excited to have you on the show to discuss kind of macro themes when it comes to the more precious metal stock sector. And we might even get into a couple stocks here, but overall, I'm going to be having you on the show on a more regular basis. So it'll give us time to dive into a lot of the other concepts that I think some precious metal stock investors are really struggling with right here. More on a macro, big picture front. Look, we've had gold hanging up very close to all-time highs. Silver is largely traded in a range. It's nowhere close to its all-time highs, but still at a decent price for some producers to make money. However, valuations down into the stocks are crappy. Let's just be honest about it. Both large and small companies continue to struggle. A lot are way off of their all-time highs. Lawrence, you've been in this sector for a while. Have you ever seen it this bad for the stocks?
Corey, I really haven't. First of all, let me thank you for having me on your show. I know it's a great show and you got a great audience and a lot of reach. But to answer your question, no. Well, yes and no. I got full time into gold stock investing. I've kind of been interested in it for 30 years, but I really picked up the tempo in 2008 because the global financial crisis informed me that the governments were going to print a ton of money and we had a real inflationary world coming to us over time. And that was when I kind of pivoted. Before that, I'd actually been a venture capitalist and had been an investor in technology companies for 25, almost 30 years, and including the internet and stuff. So I started following PMs really and PM mining companies really heavily in '08. Okay. Had a couple good years, then obviously got my teeth kicked in from 11 to 15. And this kind of reminds me of 15. I mean, it was pretty much this dead in 15, pretty despondent. Everyone had pretty much given up, et cetera. As you recall, gold had gone from a $1,900 high in 2011 to a 1,050-ish low in 2015, and the stocks were left for dead. The sentiment was terrible. The multiples were low. It was similar to today, but I'd say this even feels a little bit worse because we're fundamentally still in a bull market. I mean, that happened in the case of a real bear market for gold. Gold had gone down from 1900 to 1,000. I mean, here we're still kind of in a bull market for gold. I mean, gold, as you point out, is only about 5% away from its all-time high. It's at 1950-ish roughly today, and these companies many of the companies make decent money at this level, and yet the stocks just trade like death. I mean, it's been a real apocalypse, and as we talked about pre-show, there's some reasons for that, but it's been very hard for all of us, to kind of keep the faith in the sector, and yet I also know from experience and having been an investor my whole career that sometimes when things look this dark, that's the best opportunity in the sense. I mean, it kind of looked this way for the oil guys back in the 2016-17 timeframe, and then oil really caught a bid and they went on a tear. And so I feel like that's what's coming to us, but it's not quite here yet, and so it's been pretty tough.
Yeah, Lawrence, you said it. I mean, it's interesting the disconnect between the period you mentioned coming out of the great financial crisis, which is also when I got interested in the sector, and the mania that we saw from 2009 to 2011 in the precious metals when people were watching what the central banks were doing, watching weakness in the financial sector. If you compare that to now, there still are some concerns about the financial sector and commercial real estate, how that may affect financial institutions. But as you mentioned, the gold price is doing a lot better than the mining shares valuations are. Let's dig into why you think that's the case, because the average cost right now for producers is about $1,350 on the AISC, the all-in sustaining cost. $1,950 gold, they're making $600 margins, but these companies are being priced like they're going to fail. And when you look at development companies, same thing, the ounces in the ground are just not getting the value. Why do you think there's such a huge disconnect between where the price of the metals are and where these mining stocks are being valued?
Yeah, it's a great question and something I think about every day. And I'll tell you my theory, and I'm not sure it's correct, but it's my theory. I think the metals are holding up pretty well because I think gold in particular, and silver not as much, is really good at looking around the corner and knowing what's coming next. And we all know that Jay Powell has been very tight since early 2022, and they had enormous. I mean, COVID created enormous growth in money supply. We've slowed it way down, and yet gold and interest rates have gone from 25 basis points to 5.25. I mean, that in general, historically looking back, that kind of an increase in the real rate of interest would have just crushed gold. And yet gold has hung in there in the mid to high 1950s. And why is that? I think the reason that is the case is that the gold investors are smart enough and they look around the corner and they know that these Federal Reserve policies cannot continue, and that the Fed will have to turn the printer back on. They will have to pivot. They've done it every time in the past. We saw they did it just recently in March with Silicon Valley Bank. They did a mini pivot. And so gold smells that it's coming. And that's why gold is held in there, in my opinion. The stocks, on the other hand, are kind of a different kettle of fish. They're more risk oriented. And I think that people who are looking at the stocks are much more thinking to themselves, okay, I know the costs for all these companies are going up. I mean, you're right. ASICs maybe are running at 1,300 an ounce, but as recently as a few years ago, they were running at 1,000. So that's a 30% increase in a couple of years, and all the costs and inputs are going up. And then if you go to the stock, kind of the Bloomberg terminal, and you look at what the consensus estimate is for gold 5 years out, it's 1,750. Well, if you're okay, so you're a stock investor, you're building a model. If your costs are going to continue to go up from 1,300 and your selling price is going to be 1,750 in 5 years, that's a shitty business. So you don't want to own that stock. Now, I don't think there's any chance that gold's going to be at 1,750 in 5 years. I think gold will be at 3,000 or 6,000. But whatever it is, I mean, and that would be a very good business. But right now, that's not what the market is saying. And as we talked about also before the show, I mean, the market in general, I believe, still is somewhat inclined to, I mean, the gold market doesn't believe it because gold investors are sophisticated and big money and they think long term. But the general stock investors, I think, kind of believe the Fed is going to have a smooth landing of the airplane. We're going to go back to a deflationary world like we had for the past 40 years. Inflation's not going to really be a problem. You're not going to really need gold. Therefore, you're not going to really need gold stocks. So to me, that's why we have the disconnect right now. The buyer of gold is a foreign central bank that can see that the U.S. is fundamentally bankrupt and getting more bankrupt by the day. Or the buyer of gold is a very, very wealthy, savvy individual who says, I want to protect my wealth multi-generationally, and I know that they can't print this shit. And it may not be going up today, but I don't care. I'm not buying this for 6 months or a year. I'm buying this for 10 or 20 years. And so, gold is as cheap in monetary terms as it's ever been. It's as cheap as it was in 1971. It's as cheap as it was in 2000. And in both of those cases, in 71, it did a 22 bagger. That's a little exaggerated because the $35 reference price was a manipulated, Bretton Woods set price. But, from 2000, when it was at 250, it went to 1950 or 1900-ish in 2011. So it's a 7-bagger. And the same, if you look at any charts and you look at the analysis of the amount of money outstanding as against the amount of gold ounces that we have, that it's just as cheap as it was. I mean, I often point out to people that there was a time, it's quaint, but you can go back and you can say, pre-Nixon abandoning the gold standard in 71, you could take a monetary aggregate like, the equivalent of M2, and you could divide it by the 261 million ounces that the United States owns or theoretically owns, and some say they don't. And you come up with $35 an ounce. I mean, in other words, the money was covered by the gold that we held. If you did that same, just to show you how much money has been printed, Corey, if you did that same calculation today to make those sides balance, gold would have to be $80,000 an ounce. And of course, it's 1950. So the point is there's been a lot of money printed. And the reason the gold price hasn't gone up is because with paper gold and other derivatives, they've been very, very good at suppressing it. But it's like a balloon that's been held underwater, in my opinion. And that suppression, will have to come to an end. I mean, most market rigs ultimately fail. I mean, the London gold pool in the 60s, if you Google it, it's an interesting story. All the deficits of the 60s were what led to Nixon breaking the standard in 71. And that London gold pool, they were trying to hold that reference price at $35. They couldn't do it. And eventually they had to abandon, all the central banks were trying to hold it there. They couldn't do it. And eventually they had to abandon it. And I think that's what's going to happen here too. Gold's going to get through 2,100, 2,200. It's going to squirt up to 3,000. And then it's going to be game on because, to me, what drives all of that is kind of the common knowledge game of everybody coming to realize that the U.S. is bankrupt and that there is no way mathematically there is no way for the U.S. to keep its sovereign debt market healthy without printing. And that, of course, is a different issue, which is inflation. But the notion that they can, they can't make these bonds money good with interest rates. They just can't. They're going to drive the whole thing right into the ground because the interest expense is going to become too high. And it's a doom loop. As the interest expense gets higher, the deficits get bigger, et cetera. So, it's coming. But, for those of us who are in it, it's like so many financial things. Just because it's certain doesn't mean it's going to happen imminently. So,
that's a good point there, Lawrence. But let's get into the stocks a little bit more because, again, it's across the board that the stocks are struggling. And a lot of people are saying, well, the majors, the mid-tiers, they need to start taking over some of these juniors. But the deals that we're seeing done for the juniors, for the development plays, haven't been exciting. So where does that investment demand need to come from in your eyes, whether it's inside the gold sector or outside, to actually light a fire and get these stocks moving?
Well, I think that what needs to happen is, one thing that needs to happen is the U.S. stock market needs to tank because it kind of competes for capital. And as long as people think that's a good place to be, because it's been a good place to be for the last 20 years, the capital's over there. It's not with us. So we need that thing to tank a little bit. But moving back to the gold stocks themselves, they represent stunning value, and eventually that value will be recognized. What I call the sweet spot are the mid-tier to major companies that have serious profitability, serious cash flow, good projects on the books, the ability to over time grow their production, and they're trading at low multiple. They don't need additional financing, and over time, they will re-rate at much higher multiples. I've got big good companies that sometimes trade at 2, 3, 4 times cash flow, and that, a cash flow yield of 50% or even 25%, that's just absurd. It's absurdly cheap. So that there'll be a re-rating that'll happen in the big producers first. As we talked pre-show, the big producers, if they were smart, and some are and some aren't, but if they were smart, they would be out using their paper to try to buy the juniors, because the juniors have all just been left around for dead. And, when you're looking at gold stocks, it's very important, in my view, you put them in two buckets. Are they generating cash and they don't need more capital to keep going? That's a good bucket. That's a very good and safe bucket. Obviously, if prices of metal fall, that could change. But assuming today's price, are they generating cash? All right, that's a positive. And then there's everything else, a development story, a drill story, whatever it might be. And those companies have to sell shares to dilute themselves to keep going. Some of them they've spent millions and millions of dollars. They've developed huge deposits. They've done a ton of work. They've got mines ready to go, or in some cases halfway built, and they're trading for pennies on the dollar. If I were a corp dev guy at a big mining company, I'd be out there picking up these little guys because you can do it in an NAV accretive way. A lot of the bigger companies are selling at 0.8 to 1.1 times NAV. And I've got all kinds of developers and small companies that are selling at fractions of NAV, 10%, 20%, 30% of NAV. So yeah, there will be a wave of consolidation. As we also talked pre-show, one of the negatives of that consolidation from those of us who are investors in these small companies is, sadly, a lot of our fellow shareholders are willing to sell out for a 30% premium. And, when you've got a good small company that is a 5-bagger over time, and an offer comes in and it gives you 20% upside or 30% upside, I don't want to take it. I want a much bigger upside in order to be enticed to sell. But sadly, a lot of companies do take it because they maybe, in some cases, don't have any other choice, or they're not necessarily always looking out for the shareholders' best interest.
Yeah, Lawrence, it's an interesting dynamic right now because it's really a story of the haves and the have-nots. There's companies that are cashed up and they can continue to do work programs, or they're a revenue-generating company, and then there's all the other companies that have their hand out looking for more capital to keep funding the operation. So it is a time where larger companies could be more predatory and scoop up some deals. But I've watched you for years in interviews and on panels discuss how you hold those two buckets, the producers that are generating revenue, maybe some of the royalty companies, and then the other bucket of the developers and explorers. Let's dig into that a little bit more as far as people listening, how they should consider their portfolio construction, because I see a lot of people, Lawrence, that get into the space and they immediately jump into the riskiest element of it, the drill plays, the furthest down the food chain, the ones that are trying to make a new discovery, but they don't have an allocation to producers or royalty companies or revenue generating companies. So between those two buckets that you outlined, how would you recommend a lot of people enter the space if they're new or just looking at
I
it?
mean, the first thing I would say is in general, this is a really tough space. It's kind of like, don't try this at home. I mean, but having said that, I'll offer my views on it. Because it's a tough business. I mean, this is, you're trying to find minerals, you're trying to break rocks